Welcome to StaalX Construction and Steel Podcast. Episode 10, Construction Spending and Construction Start Trends Diverge. Before we start, quick shout out to StaalX. If you work with steel, rebar, wire rod, mesh, any of it, StaalX makes your life way easier. You can check real prices, get instant quotes, and order everything online without waiting on emails or chasing people down. Super simple, super fast. If you haven't tried it yet, head over to StaalX.com and make a free account. Alright, now back to the episode.
Welcome to the Deep Dive, your shortcut to being genuinely well-informed. Today, we're tackling a real head-scratcher. It's one of the most confusing data conflicts we have seen all year, really. The construction sector is sending out, wildly contradictory signals. On one hand, you have data showing that broad spending is contracting, and then almost immediately after, you get data showing an explosive surge in groundbreakings.
It's a tale of two economies, but they're happening inside the same industry. It's fascinating. Our mission today is to really get under the hood of this tension, this split between the soft everyday volume and this overwhelming high-value mega project activity. And the key thing, what this really means for Q1 2026 in a critical supply chain. We're talking about the North American steel market.
Right, that's the core focus here. We're not just going to recite numbers for you. We want to figure out whether it's the general market slowdown or this concentrated surge of capital that's going to define prices and availability of materials next quarter.
Exactly. The goal is to give you the context you need to actually interpret the supply chain outlook. You have to know if these mega projects are just a fleeting anomaly or if they're the dominant force that's really driving market demand right now.
Okay, let's start with the hard reality check. The data that really set the stage for all this tension. We're talking about the August 2025 spending data. It was analyzed by the Associated Builders and Contractors, ABC, using U.S. Census Bureau figures. And it paints a pretty clear picture of a sector cooling off fast.
That's where you see the general weakness. It's right there in the numbers. Non-residential construction spending, it decreased by 0.2% in August. And while, the total volume is still high, 1.24 trillion on an annualized basis, it's the direction that matters. And the direction was down.
And ABC was quick to point out this wasn't just some isolated incident, right? This was the third contraction in 4 months. And maybe even more worrying, spending is actually down 1.5% year over year. When you see those consecutive drops, that implies there are some real economic headwinds at play.
It absolutely does. And the weakness was widespread. Spending was down in 10 of the 16 non-residential subcategories. Private non-residential spending dipped 0.3%, and public spending wasn't far behind. That was down 0.1.
I want to dig into where that weakness was really concentrated. The ABC chief economist, Anirban Basu, he specifically called out manufacturing and commercial categories. He said they were particularly weak in 2025. But wait a second, manufacturing was weak. That feels, a little counterintuitive with all the infrastructure money that's supposed to be flowing.
But that's a key distinction. The August spending data, that reflects money actually being spent on projects that are already underway. Basu's point was that high borrowing costs and just this elevated uncertainty have basically sidelined the private, more speculative projects. Think about the mid-sized factory expansions that usually drive that kind of sustained commercial activity.
Okay, that makes sense. So if you're a mid-sized company and you're thinking about building a new factory wing, the cost of capital is just too high to make the numbers work right now. It slows down that whole velocity of standard construction.
Precisely. The big money you hear about flowing into manufacturing, that's often concentrated in a few massive multi-billion-dollar projects. Those don't really show up in the spending data until much later, and they tend to skew the whole picture. In August, the only real sustained momentum we saw was, and I'm quoting here, almost exclusively confined to the data center segment, and a tiny 0.2% bump in healthcare.
Right. And data centers are the classic exception that proves the rule. They're often funded by these cash-rich tech giants who aren't really facing the same capital constraints as a typical builder.
That's a great way to put it, yeah. The takeaway from ABC was clear. Private activity is buckling under, a combination of things. High borrowing costs, extraordinarily elevated uncertainty, and rising material costs. And you have to consider this, that August data doesn't even reflect the negative shock from the government shutdown threats that came later, or the new tariffs that were implemented. The general outlook was already getting pretty dark.
Okay, so that sets the mood. Softness, high costs, a lot of anxiety. which makes the pivot to the October starts data from Dodge Construction Network almost unbelievable. How do we go from a gloomy spending report to an explosive, groundbreaking report just 2 months later?
The whole mood just shifts completely. Because now we're moving from tracking broad spending to tracking these initial massive commitments. Total construction starts. So the financial commitment to break ground, it jumped an incredible 21.1% in October. It hit an annual rate of $1.53 trillion.
21%. I mean, that's not a normal fluctuation. That's a statistical distortion. What on earth drove that kind of movement?
The answer is scale and concentration. 10 separate projects, each valued at $1 billion or more, broke ground in October.
That kind of capital commitment in a single month is so massive, it completely washes out the witness you see everywhere else.
So the surge isn't a reflection of broad economic health at all.
Yeah.
It's really the execution of a handful of enormous projects that were already in the pipeline and finally got their financing. That is the critical distinction for you to internalize here. Sarah Martin from Dodge confirmed it. She said growth is being, quote, propped up by high-value mega-project activity. Outside of these specialized high-tech buildings, growth looks, well, more moderate. It's a market that's completely split in two.
So let's break that down. Which sectors saw this sudden burst?
Well, non-residential groundbreakings overall surged 17.9%. Manufacturing activity saw a 107.2% spike. That directly reflects those big policy-driven projects we talked about finally hitting the ground. And then office and data centers, again, the exceptions, they surged 45.5%.
And I'm guessing non-building side, so infrastructure, utilities, that must have been equally huge given the size of these energy projects.
Immense is the right word. Non-building starts rebounded 59.4%, and that was led by utility construction, which saw an astonishing 384.5% surge in 1 month.
We have to use some examples here just to get a handle on the scale. We are talking about the $15.1 billion Calcasieu Pass LNG export terminal in Louisiana. To put that in perspective for you, that one project is worth more than the entire annual budget for many state transportation departments.
Absolutely. Then you add the $7.5 billion Meta-Hyperion data center, also in Louisiana, and the $1.7 billion Eli Lilly manufacturing plant in Indiana. These aren't just regular projects. They are multi-year commitments that lock in demand for enormous amounts of materials, especially steel.
And this concentrated strength just makes the general market weakness look even starker. So while these giants were committing billions, the everyday housing market, residential construction, it's actually decreased 15.4% in October. That was led by a really steep 38.5% pullback in multifamily starts.
The divergence couldn't be clearer. Residential developers are immediately sensitive to those high borrowing costs that Boss Sue mentioned. When mortgage rates are high, the economics for a new apartment building they fall apart instantly. So the private volume-driven market pulls back hard, while the federally backed or tech giant-funded mega-project market just hits the accelerator.
That is the modern construction landscape laid bare, a game of haves and have-nots. Okay, so how do we translate this story of uneven investment into the materials market? This is where it gets really critical for anyone in the supply chain.
Right. And for that, we turn to the StaalX Q1 2026 forecast. For context, StaalX is one of the top sources for commodity price forecasting. They have deep intelligence on things like mill utilization and input costs. And they identify two massive forces that are pulling the steel market in radically different directions for the start of 2026.
All right, let's start with Force A. This is the demand and cost push that wants to drive prices up. What's powering that rocket?
In a word, data centers. The rush for data center construction, and by extension all these other mega projects, is providing this really strong non-seasonal demand momentum, specifically for what we call long products. We're talking about rebars and wire rods, the foundation of heavy construction.
And non-seasonal is the key phrase there. Normally, winter slows everything down, demand eases, mills build inventory, but not this time. These critical projects, they operate year-round.
Exactly. This demand is expected to just continue right through Q1 2026. It's defying the typical winter lull. And to compound that, scrap prices, a primary input cost for most mills, they typically rise in the colder months. It's harder to collect, supply constricts, and so the input costs spike.
So you have nonstop urgent demand for rebar, pushing right into a season where the costs to make that rebar are naturally going up. And the report says U.S. rebar and rod mills are already running near capacity.
Yep.
That sounds like a perfect storm for some strong price increases.
It's the ideal environment for a pricing rally for those long products.
Yeah.
But Force A isn't just about rebars. The report also pointed out that flat-rolled products, the real volume drivers in the market, used in everything from machinery to appliances, are also starting to gain momentum.
So flat-rolled is the real wild card here. If long products are like a steady climb, is flat-rolled more of a rocket, capable of faster, more volatile movement?
That's a great analogy. Flat-rolled steel is notoriously more sensitive to broader economic swings, to speculative buying. If momentum starts building there, driven by all the ancillary equipment needed for these massive projects, StaalX suggests that segment could be, quote, a whole lot more explosive in terms of pricing.
Okay, that is Force A. Everything pushing toward a pricing rally in the first quarter. But now we have to introduce Force B, the big looming counterforce.
And Force B is the threat of new supply. Specifically, what happens if new greenfield rebar mills, we're talking facilities like Nucor Lexington and Hybar, ramp up their production faster than the market expects?
The sources seem to indicate that these places are running, but they're not making a serious dent in the supply tightness. Not yet, anyway.
Correct. They're in the ramp-up phase. But the sheer scale of a modern steel mill means that when they do hit full stride, they introduce hundreds of thousands of tons of new domestic capacity.
Yeah.
If they get to full capacity rapidly in the first half of 2026, that fundamentally changes the entire supply equation.
It puts a ceiling on Force A. No matter how urgent the demand is, new domestic supply just pouring into the market acts as an immediate cap on any future price hikes. It kind of cancels out the threat of the scrap cost push.
That is the critical battle. You have a construction sector that's completely fractured, it's soft volume everywhere, versus this overwhelming high-value mega project strength in just a few concentrated spots.
And that tension translates directly into the steel market,
Right.
where non-seasonal urgent demand from those billion-dollar data centers is battling the imminent threat of all this new rebar capacity coming fully online. It's a true market tussle, and it's going to resolve itself one way or another pretty rapidly in Q1 2026.
The entire market trajectory for the beginning of next year hinges on how this conflict resolves. Do the new mills ramp up quickly and flood the market? Or does the unwavering financial urgency of Meta and the LNG terminals keep utilization high and prices rising?
Which brings us to our final provocative thought for you to consider. Which of these two forces, the sheer financial urgency and non-seasonal momentum of data center demand, or the speed and scale of new domestic mill production, which one will ultimately prove stronger in defining the market's direction through the beginning of 2026? The answer to that question defines the line between a strong pricing rally and a sudden, supply-driven equilibrium.
Thank you for listening. Explore more at www.staalx.com.